All right. So we are going to go through exercise 310 on page 347 as the second exercise, practicing the analyzing transactions and journalizing the transactions. So exercise 310 on page 347 says, the May transactions of Chulik Corporation were as follows. It's got May 4th, 7th, 8th, 9th, 17th, 22nd, and 29th. And it says instructions, journalize the transactions, do not provide explanations. Again, we are not providing explanations for any of the problems that we're doing, okay? All right, so it says May 4th. Well, first of all, who are we? We are Chulik Corporation. It doesn't say what kind of company we are, but we're Chulik Corporation. That's who we are. May 4th, paid $700 due for supplies previously purchased on account. So whenever we see pays or paid, we know that that's cash, and we know that if we're paying cash, cash is going down. Cash is an asset. Assets have a debit balance. So that means that we have to credit cash to make it go down. So that's going to be the second part of the transaction. Because we always do debits before credits, right? So we need to figure out what the debit part is. So let's see. So it's paid $700 due for supplies previously purchased on account. So we don't debit supplies because supplies are not going up. We debited supplies when we first bought them, but it says we're paying for what was purchased previously on account. So if we bought it on account previously, that means we bought it on accounts payable. And if we're paying accounts payable, then accounts payable is going down. And accounts payable is a liability. Liabilities have a credit balance, so to make them go down, we have to debit them. So that's going to actually be the first part of our transaction. So May 4th, we're going to debit accounts payable to make it go down because we're making a payment on it. We're debiting it $700. And then we're going to credit cash because remember, paid or pays, our cash is going down, right? Okay. May 7th, performed advisory services on account for $6,800. So, well, obviously we're some kind of a advising company because we provided advising services on account for $6,800. So, if we provide a service, that means that what we're getting is revenue. So we're getting a service revenue, $6,800, but revenue has a credit balance. So to make it go up, we have to credit it. So that's the second part of the transaction. So what else did we get? Well, it says we performed advisory services on account for $6,800. So whenever it says on account, it's either accounts payable or accounts receivable. Unless it says it's a note, on account on a note. Now, we provided the service, so that doesn't mean we don't have to pay because we provided the service. So we're going to be receiving the money later because it says on account. So accounts receivable is a debit balance account. In order to make that go up, we are going to debit it. So that's the first part of the transaction. So May 7th, we're going to debit accounts receivable. Accounts receivable, $6,800. And we already figured out that we are crediting service revenue, $6,800. Okay? All right. Now we're going to go to the third entry, May 8th. Purchase supplies for $800 on account. So what did we get? Well, we got supplies. We purchased supplies. Supplies are an asset. Assets have a debit balance. So in order to make it go up, we're going to debit supplies. So this is going to be May 8th. We're going to debit supplies. And we're debiting supplies for $850. And it doesn't say paid or pays, right? So it's not cash. It says on account. So if we're purchasing on account, that means we're purchasing on an accounts payable, which is a liability, and liabilities have a credit balance. So to make our accounts payable go up, we are going to credit it $850. All right. Now we're going to go to the next date, May 9th. Purchased equipment for $1,000 in cash. So what did we get? Well, we got equipment. What is equipment? Equipment is an asset. Assets have what kind of a balance? They have a debit balance. So to make it go up, we're going to debit it. So we're going to debit equipment. We're debiting equipment $1,000. And it said that we purchased equipment for $1,000 in cash. So that means we paid cash. Cash is an asset. Assets have a debit balance. So to make it go down, we have to credit it because whenever we pay cash, it goes down. Okay. We go to the next date, May 17th. Paid employees $530 in cash. So whenever it's paid or pays, we know it's cash. We know that cash is an asset. Assets have a debit balance. So to make it go down, we have to credit it. So we know that's the second part, right? Because we have to do the debit part first. So we paid employees. So if we're paying employees, that would be salaries and wage expense. So May 17th, we're going to debit salaries and wage expense because expenses have a debit balance. So to make them go up, we're going to debit it, 530. And then we are going to credit cash because we paid cash. All right, the next entry, May 22nd, received a bill for equipment repairs for $900. So what did we get? Well, this is kind of a tricky one, and I think you might get one kind of like this one, but we got a repair, right? We got our equipment repaired, and we got a bill. So bill means we're going to have to pay it later. So that's going to be a payable, an accounts payable, which is a liability. So to make a liability go up, we have to credit it because it has a credit balance. So that's the second part of the problem. So the first part is actually an account called maintenance and repairs expense. And the way you might know this is that in our problems, there is a link there where you could look at possible accounts and it'll list the possible accounts that you could use for that problem. So just know that if it's a maintenance or a repair expense, that now you know that there's an account called maintenance and repair expense. Repair expense, and it's an expense, and expenses have a debit balance. So to make it go up, we're going to debit that 900. And then we already said it's an accounts payable. We're going to pay it later, $900. We're liable to pay it, accounts payable. All right, last one. May 29th, paid $1,200 for 12 months of insurance. Coverage begins June 1. This is going to introduce a new account for you. So we know pays are paid, right? Pays are paid is cash. Cash is going down, so we have to credit it. That's the second part. So what do we get? Well, we got an insurance policy for 12 months. So it's an asset, and it's an asset that we used. At one point, we called it prepaid expense, but this is, if you were to look at the chart of accounts, there's actually an account called prepaid insurance. And this is an asset because we're paying for our insurance in advance for the full year. So if we cancel it after 1 month, the rest of the money that's left, we're going to get back. So it's an asset until we use it up. And when we get into the chapter on adjusting entries, you would make an entry every month to move over the portion of insurance that you use every month until you've used it all up. So we are purchasing insurance in advance. So that's called prepaid insurance, which is an asset. And if you go back to chapter 1 and 2, you'll see that we had prepaid expenses in the asset section. So we're just making this expense a little bit clearer by calling it prepaid insurance. You're probably going to see prepaid insurance, prepaid rent. I don't think you'll see prepaid utilities, but those are possibilities. But again, your problem, if you look at the list of accounts, is going to show you what the possibilities are. So this is prepaid insurance, and it is $1,200. And we are going to credit cash because we paid it. Oops, $1,200. Okay. Now, it is likely that you will see all of these types of entries, including the common stock entry, the stuff we did in exercise 3.9. This is exercise 3.10. You can get any of these possible entries on your exam. and your homework. So you want to make sure that you kind of have a decent handle on how to do the entries for these type of transactions.